Welcome to our June quarterly review. Well, it's obviously no understatement that Brexit has put a dampener on any end of financial year celebrations. Before we talk about Brexit and also the outlook for our investments, it's probably worth a quick snapshot in terms of what the market's been dealing with over the last 12 months. And clearly it's been fixated on the sustainability of economic growth. And the reason for that is that the market's come to realise that monetary stimulus only goes so far. If we want to continue the path of economic growth, then what is really needed to kickstart now is fiscal stimulus, and in particular infrastructure, as well as regulatory reform, taxation reform, the sort of paperwork that's strangling, particularly small and medium-sized businesses. And as I noted, the best way to really kickstart that process is fiscal stimulus through infrastructure, because that gets other companies or the private sector starting to spend. And in particular, if you actually look at balance sheets today, there are record amounts of cash sitting on balance sheet, despite the fact that in the US, for example, 100% of earnings are being returned on average to shareholders in the forms of dividends and buybacks. And it really just goes to highlight that companies are being very, very conservative. So again, reiterating the fact that if governments kickstart the process with infrastructure spending, I'm pretty confident that the private sector would also join in. So what that meant over the last 12 months is that valuations were starting to diverge significantly between the so-called defensive sectors and the cyclical sectors, those sectors more exposed to short-term economic growth. In fact, valuations have diverged to such an extent that relative to historic norms, defensives were approximately two standard deviations above their historic norms. And on the flip side, the cyclicals were two standard deviations below. And in fact, European bank stocks were selling at 75-year historic lows. So that's basically the situation we found ourselves in just before Brexit. But the reality is, if you actually looked at what was going on in the US economy, all the signs were that two steps forward, one step back type of framework that we've been alluding to over the last 5 years was continuing. In fact, in June, we had a situation where we had record job openings in the US. Home sales were at the highest levels in 6, 7, 8, 9 years. And in fact, on the day of Brexit, the US bank capital results came out from the regulators, and it highlighted that they could withstand some absolute extreme events. That capital was in excess of what was expected, and therefore that would flow through to increased dividends and buybacks. These positive fundamentals were being reflected in the fact that investors were starting to question the extreme valuations we saw in the defensive sectors, and you were starting to see ongoing rotation from those cyclical sectors from the defensive sectors. And immediately before the results of Brexit came out, price action was in fact reflective of confidence in terms of the economic outlook, the positive bank results. Bank stocks were up pre-market, and the framework that we're operating under seemed to be progressing according to plan. Then obviously came Brexit. As we've noted in our previous video on Brexit, immediately after the vote, even those that had campaigned for to leave were pretty much conceding defeat. And an hour later, obviously things had turned full circle, and people started to react to the fear of what this might mean to the sustainability of economic growth. Now, I don't want to repeat the commentary that we've been bombarded with in terms of Brexit, and in fact, if you refer to our recent video on our thoughts on Brexit, we cover the key points in that. But clearly, this is an outcome that we didn't expect. We probably made the classical analyst mistake of expecting the logical outcome, particularly when the fundamental short term seem to be ticking the boxes in terms of our outlook. But bottom line, it's a result that was unexpected and obviously had an impact, a significant impact, particularly on our European investments, on our portfolio over the June quarter. Obviously, that impact being concentrated in the last week of the financial year. Now, obviously the issue is the impact on earnings, economic growth. One of the ironies of the situation is that those who voted to leave have in fact suffered the biggest dent in consumer confidence. So the bottom line is that it's actually very, very hard to work out what the short-term impact on the economy will be, and in particular the earnings of the companies that we have investments on in Europe. And again, as we reiterated in our previous video, the short term will be very, very different to the long term, and the long term is really what's important. And clearly that will depend on how Europe responds to this. Europe, as we know, is facing all sorts of issues in terms of a genuine European Union, reducing the regulatory burden on the economy. And so maybe the flip side of this is the fact that they'll actually get into gear in terms of creating a true European Union and breaking down some of those barriers that have been impeding growth. On the other hand, there could be a worst case scenario where the whole European Union, as some have suggested, might break down, and obviously that would be a negative. Our own thoughts are that we'll probably continue to muddle along. This will create further impetus, and we will get to the end result that the European regulators are in fact looking for. So obviously the issue is economic growth, the impact particularly in Europe and the UK, and the effect that has on earnings. Now, relative to other growth scares, this situation is very different. It's actually a fundamental change to the framework that we're operating under. It will take time to work out the true impact, and part of it will depend on how the UK does in fact respond. At the moment, they look like they're in chaos, but the reality is there will be order coming from that chaos. And now that the ramifications of what they've done starts to sink in, you would hope that there would be some, adjustments in terms of making sure that they respond in the proper way and therefore turn what looks to be a big negative at the moment into a positive outcome longer term. Now, it's the old trick. As we all often say, once an event like this occurs, you really need to look forward, not look back. Unfortunately, it has occurred. It wasn't, as we've mentioned, to our expectation, but we now need to deal with the appropriate risk-reward framework going forward. To a certain extent, we have to take what's happened on the chin and make sure that our investments going forward are reflective of what we think the true risk-reward now is. So it really comes back to that favourite Peter Lynch quote, the day after the market crashed, people began to worry that the market was going to crash. So in terms of how we see it going forward, obviously UK and Europe will be the centre of impact short term. And I guess the issue overall is the impact that it has globally. Will it actually throw a spanner in the works in terms of that slow economic recovery? Now, the interesting thing is, just on Friday, the US again came out with an employment number. To the relief of the market, the employment numbers were again quite solid, and the market reacted in a very positive manner to that announcement. And in particular, the more cyclical sectors of the economy were the stronger parts of the market. So, I suspect the reality is the US is the biggest economy in the world, and that's what really matters short term. And over the next couple of weeks, the earnings season kicks in. And the interesting thing, if we look back, again pre-Brexit, it appeared that the second half was really setting itself up for some increased economic momentum in the US, that the earnings cycle had troughed, and therefore that would provide a positive backdrop to the market. But we'll see what happens in the next couple of weeks. So I think the best way to really take a look at this is really just go through each of the sectors that we're invested in, have a look at the impact of Brexit and what our outlook is going forward. First of all, our UK and European banks. The basic story behind our UK and European banks is that post the GFC banking crisis, capital ratios would be restored. That would allow for higher payouts of earnings and thus higher dividends. And with dividend yields looking like high single digit, 6, 7, 8% in a low bond environment, that would be a very positive environment for these banks to be re-rated. It was basically buying the CBA equivalents in Europe and the UK. Now the reality is bank balance sheets have dramatically improved, and that is allowing for higher payout ratios and higher dividends. So really the issue of Brexit has nothing to do with balance sheet risk, solvency risk. It's really to do with what's going to be the impact on earnings, and therefore will the earnings be delayed? Will earnings come down? And if they come down far enough, will in fact that put pressure on the ability to pay out these dividends? Now obviously the UK is going to be the most impacted short term in terms of the economy. And then depending on how Europe responds to this situation, people are obviously very nervous about that as well. It's difficult to really determine what the impact on earnings will be. One has to put that against the fact that the stock prices have declined significantly. And also the currency in relation to the pound has also come down. So you've probably seen a 30 to 40% adjustment in these stock prices when you adjust for currency, and therefore are you going to get a 30 to 40% decline in earnings? I suspect not. If you look at current earnings, these stocks are now selling on 6, 7 times multiples. In the case of ING, they're on a 7% dividend yield, so they're baking in some pretty dramatic declines in earnings. But the reality is we'll have to wait and see. Depending on what happens in the rest of the world, that will also impact the earnings outlook. Clearly with lower rates for longer, it's going to put pressure on interest margins, loan growth. But again, I'd come back to the fact that these are dramatically different banks relative to where they were 5 years ago in terms of both the bank balance sheets, their funding. They're much more reliant on deposits from the consumer, which tend to be pretty stable. And so I suspect the market has reacted, overreacted to the impact on earnings, but that's to be expected because basically when you have such a fundamental change, typically the market discounts the worst case scenario first and then tries to look through the noise and work out what's really going to happen on earnings. So given the price adjustments, given the dividend yields that these stocks are on, at this point in time, I suspect the best solution is to really just stand firm and over time let the market respond with greater certainty and therefore some re-rating in these stocks from heavily discounted valuations. The second most impacted would be our European property investments, Spain and Ireland. And again, the market is reacting initially to concern about what will happen in Europe. The interesting thing is, again, if you look through May, June, both Ireland and Spain were seeing strong signs of growth. Rental yields on property were starting to increase. So again, the story was well and truly playing out. In fact, just last week, Spain came out with their latest employment numbers, and it was, I think, the second biggest fall ever in terms of the unemployment rate. Obviously from very high levels, but it highlighted that you're starting to see traction in that economy, and relative to Europe, it was performing quite strongly. And Ireland continues to see strong underlying growth. In fact, you'd think longer term it's a beneficiary of Brexit because a lot of the UK-based corporates who want access to the European markets will probably shift their European headquarters to Dublin, and that again is positive for demand for office space, housing, etc. So at the moment there doesn't appear to be any change in those fundamentals, but again it's obviously too early to tell But both of those themes, Ireland and Spain, in terms of the recovery of their property markets, were coming from very depressed levels. So we expect medium to longer term that the fundamentals are still in place. If we then look to, say, the US banks, less impacted, and that's reflected in the price action. Probably down about 7 or 8% from Brexit levels. And as I mentioned, very strong capital results for post the regulatory tests. And again, we'll ultimately see in the results that are starting to come out this week, whether the underlying trends are continuing to come through. But as we noted, the dividend story continues to play out. They're returning 80-90% of their earnings. Dividend yields are on effective 5, 6, maybe 7%. So again, in a low bond environment, as long as the US economy continues to maintain some forward progress, we expect that those valuations will start to reflect those fundamentals. Then we have our US housing, the sort of Las Vegas recovery plays. The interesting thing about the housing stocks really have brushed off Brexit. They continue to edge higher, probably on the back that the housing outlook and housing starts and housing sales continue to inch forward. And in combination with the banks, the reality is, I suspect without Brexit, those stocks would be performing quite strongly at the moment. Brexit obviously puts a bit of a brake on that, and depending on what happens over the next few months, it might be just a delay of what we were starting to see in terms of those stocks slowly re-rating. So they're probably the areas most impacted. UK the most, then the Spanish and Irish property, and then the US banks. The rest of the US market, it's basically back to its highs. So it, again, has kind of moved through Brexit. And clearly the consumer stocks, our brewing, our beverage stocks, really has no impact at all. In fact, short term have been beneficiaries because people are moving from cyclical to defensives in a bit of a, what I would argue is a knee-jerk reaction. If we move on to our sort of monopolistic franchises, Google, again, I doubt Brexit has really any impact. And then the exchanges are interesting. Chicago Mercantile Exchange, ICE, which owns the New York Stock Exchange, they're basically back at their all-time highs, and in fact, they benefit from increased volatility. On the other hand, Deutsche Börse, which should benefit from exactly the same trends, is probably 10 or 15% off its highs because of the uncertainty of Europe. And I suspect, though, that as things settle down, that will more start to reflect the trends that CME and ICE are reacting to in terms of increased trading volumes. So again, the exchanges I don't think will have any dramatic impact. Visa and MasterCard likewise, very much a stock-specific story. Volumes continue to be very, very strong. There has been some noise around litigation issues, and that's just a fact of life with companies that are so dominant in the payments processing system. But bottom line, Brexit not really an issue. Technology the same. Oracle is within 1 or 2% of its recent highs, and so they tend to be reacting more to sort of domestic US economic trends, capital investment in terms of technology, and as long as the earnings continue to inch along, I suspect that Brexit will really be a non-issue for that particular sector. Then when it comes to technology, our investment in Oracle, again, would appear little impact. The stock is in fact within a couple of percent of its recent highs. And I should also mention our pharmaceutical investments. That's one defensive area that we actually think the valuations are still reasonable. And the thesis behind pharmaceutical is basically we had reached a trough in research and development productivity. Those trends were starting to turn. And in fact, recent events or recent announcements from a number of the pharmaceutical companies are reinforcing that trend, and that there's a number of new areas where product innovation is starting to occur, and we might actually start to see some of those blockbuster drugs again being released to market, which will have a very positive impact on the sector. So I guess in a nutshell, the impact on Brexit is really divided up between those sort of cyclical areas, particularly obviously the banks, and those more defensive or businesses such as Visa, MasterCard, Googles of the world, that really dance to their own tune, very, very stock-specific reasons as to why we own those stocks, and I doubt it will have any real long-term impact. So in summary, I think the really important part to focus on is the fact that there are some extreme valuation disparities now appearing in the market. It reminds me a little bit of TMT back at the start of the decade. Back then, old economy, new economy. Today, it's defensive versus cyclical. And clearly, Brexit sort of reinforces those trends because it creates increased uncertainty short term, and therefore even more willingness to hide in what has served us well or served the market well short term, and those areas that are perceived to have sort of low risk of earnings in an environment where there's perceived to be high risk in terms of the economic cycle. Now, the problem with that is that it typically leads to a situation where investors further rotate into those areas and create an even bigger skew in their invested positions. The reality of life is that most investors are probably well served by a sort of core index approach, and then having around that what we call satellites or managers that are generally investing where they have high conviction over the medium to longer term. And when you get situations like this, it is in fact where you want to think very, very carefully, and rather than reinforce that sort of defensive, cyclical or valuation disparity, you actually want to be moving against it. And so I think it really just comes back to looking at your existing position, making sure you're not becoming too concentrated in the areas of the market that do have extreme valuations, and think very, very carefully whether now's the time to start moving in an increased manner towards those areas of the market that do have deeply discounted valuations. With that in mind, we're just going to throw up a chart of the long-term bond rate just to remind people that where bond rates are at the moment is not a normal event. It's an extreme event. As I mentioned, I think it has the hallmarks of TMT back in 2000. And therefore, investments, defensives, property, infrastructure, etc., who have been beneficiaries of that extreme event, one needs to think very, very carefully about. Going back to my original statement, it's about the risk reward from here on in. We have to take Brexit. It's occurred. It has been a fundamental change. There'll be time before we really understand the true ramifications of it, but you've got to come back to the basic valuations, and is that now being reflected in the underlying businesses, and where do you really want to deploy your capital over the next 3 to 5 years? So clearly with Brexit, it's a more difficult environment. Uncertainty has increased. On the other hand, valuation disparities are at record levels. And that's the environment that you really have to stick to the framework of your philosophy and process, and make sure that emotion does not override that. Otherwise, you're vulnerable to increasing your exposure to those areas that you actually want to be walking away from. And that's what we're really concentrating on at the moment. And in terms of Asia and Australia, I suspect they're relatively well insulated. So again, in terms of our Australian fund, our Asian fund, I don't see a big impact. Now, one question that has come in, and I just wanted to address, was in relation to our invested position of about 115%. Now, what I need to highlight there, that in terms of the equity side of the portfolio, the invested position is currently about 98%. The difference is our investment in our what we call our spread investments, which are really a situation where we're arbitraging our own borrowing costs relative to the variable yield that we can obtain on a number of debt securities that are very, very safe in nature. And therefore what we're really doing is just locking in a variable spread. It's been a common part of our portfolio over the last 5 years. It has come down because a lot of these variable spread opportunities are no longer available. But we still believe we can get about 10 or 15% of our portfolio invested in these instruments. And it's just basically locking in an interest spread, so we see it as very low risk. And it's basically a way of covering part of the management fees. So when you look at our invested portfolio, you should really look at the net invested equity position, which at the moment is currently running at about 98%. Another key question is the impact on the Australian dollar and commodity stocks. And that's actually a harder question. The currency I would typify it as being sort of in mid-range. Not too expensive, not too cheap. So it makes it a little bit difficult to really determine what your medium to longer term position should be. As we've highlighted before, typically once a trend is broken, which the Aussie dollar did 18 months ago, it will then continue until it's deeply discounted. So for that reason, we're continuing to maintain our offshore exposure. On the other hand, I've also highlighted that pre-Brexit, all the trends were suggesting that you're going to get a bit of an upswing in terms of economic momentum in the US in the second half. And in fact, the interesting thing is when you look at a lot of global indicators that we typically look at in terms of what's happening in the economy, momentum on a global basis was also starting to trough, and that would typically be good for the Australian dollar. So there was some sort of mixed things to deal with in the currency. Now, longer term, we still think the commodities is in a bear market. You're going to have sharp trading rallies, and for that reason, we're maintaining our bias to be offshore. But the Aussie dollar could bounce up and down around about this sort of mid-70 cent level in the shorter term.